Good evening, everyone. Welcome to the American Dream, Myths and Truths About Home Buying. This is our third webinar in the St. Joseph's College Alumni Summer Webinar Series. My name is Taryn Katusian, Associate Director of Alumni Engagement for St. Joseph's College, Long Island. I'll be one of your facilitators tonight, along with Paige Carbone, our Director, and Lisa Galasso, Assistant Director of Alumni Engagement. Our speaker tonight is Rosemarie Klupfel. Rosemarie is a New York State licensed banking mortgage loan specialist for Fairway Independent Mortgage Corporation. In addition to Rosemarie's mortgage expertise, she is also a writer and a motivational speaker. She strives to combine her business expertise and passion for writing and motivational speaking to help educate and empower others. In 2015, Rosemarie was selected as the Suffolk County Woman of Distinction for her dedication to helping others in our community. Thank you, Rosemarie, for being with us tonight, and I'll turn it over to you now to begin your presentation.
Thank you, Taryn. So, the American Dream, and before I begin, I do have to read a disclosure. This information is not intended to be an indication of loan qualification, loan approval, or commitment to lend, and other limitations may apply. Fairway Independent Mortgage Corporation, our national mortgage licensing number is 2289, and we are a licensed mortgage banker with the New York State Department of Financial Services, and we are, of course, an equal opportunity lender. So this evening, thank you for joining us, and this evening we're going to talk about buying a home, and the things that we'll be covering will be types of properties and intended use, types of lenders and getting pre-qualified, credit score and credit history, personal and business liabilities, income and employment or business history, assets and compensating factors, mortgage products and down payment requirements, monthly housing payment, fees, closing costs, and advances needed, and options to offset funds needed to close. And of course, if you have any questions, you can always send your questions in, and we'll try to get to all of them. And also, my information is on the bottom of each screen, so you can contact me directly if you have a specific scenario. And my email and direct phone number are there for your convenience. Okay, the housing market collapse. What happened? This seems to be what's been on everyone's mind for the last several years. And basically, in the 90s, they relaxed the lending criteria, so more people were able to buy homes. And unfortunately, some of them really were possibly not prepared to do so, whether they had limited income or not, it wasn't stable enough, or really they didn't really fully meet the responsibility that was going to be needed to buy a home. But it was similar to going to a car dealership. You had a certain amount of cars on the lot, and you only had so many people that were able to buy. All of a sudden, you had more people that were able to buy and less cars. So there was kind of a run on the cars. And not only when people got there were they able to buy a car, the salesperson convinced them to not get the basic sedan, but get the sports car instead, which had a higher price tag. And everyone else was doing it, so it became keeping up with the Joneses. And unfortunately, that drove the cost of the cars up to a point where they actually were worth less than people were actually paying for them, but people didn't realize it because it seemed like everyone was just buying and the prices kept going higher and higher. And eventually, that bubble collapsed, and a lot of people were left with souped-up sports cars and not being able to afford the payments. So what did they do? They left them on the side of the road, and they decided it wasn't worth paying for them, and those basically caused a ripple effect to the housing market. So you had foreclosures and short sales, and that's what happened. So now a few years have come by, and things have changed, and the market has stabilized again. So having a home has once again become more of a stable decision-making. And of course, you have to live somewhere. And people ask, renting versus buying. Well, historically, real estate has been a source of financial wealth. Mortgage rates are at historic lows. Many markets have stabilized, and rent can be comparable to your monthly housing payment, and of course there's possible tax benefits. So once again, people are looking at home ownership, and we're basically inching our way back to what it was prior to the collapse. So when the dust settled, some people were underwater, which meant the mortgage or outstanding liens are greater than the current market value. Foreclosures. Upon homeowners' default, lenders seek judicial intervention to take ownership of the property. Deed in lieu, homeowners assign the ownership back to the lender instead of avoid foreclosure proceedings on default. Short sales, lenders agree to accept less than the balance of the mortgage amount owed at the time of the sale based on the current value if the homeowner shows hardship. Loan modifications, lenders agree to modify terms of the mortgage loan so homeowners can maintain monthly payments if the homeowner shows a hardship. And a qualified mortgage, which is the ability to repay rule, the government regulation put into place to help safeguard against borrowers being unable to maintain the mortgage payments and restricts the percentage or amount of fees paid by consumers based on loan amount and mortgage product. Mortgages that do not meet the qualified mortgage ability to repay rule can come with additional disclosures and may require home counseling prior to closing to ensure borrowers understand the guidelines and fees. So these are the things that affected the mortgage process. So things have changed in the last few years. So the first thing you have to do is decide what kind of property is best suited for you. So residential property types and intended use. Are you looking to buy a single-family home, a multi-family home, which is considered a 2 to 4 unit, in which you can live in one of the units, a condominium, a townhouse, a cooperative, a manufactured housing, and of course land. So a single-family home, often abbreviated as SFH or SFR, is a home built on a single parcel of land. The pros would be single-family homes tend to offer more privacy and space than other types of homes and frequently come with private front and backyard. The con is all the cost of the maintenance falls on the shoulders of the one homeowner. With condos and townhouses whereas condos and townhouses, they share the costs that are involved. Multifamily homes are homes that are being turned into 2 or 4 units. They can be row houses, they can have multiple floors, they can range in size from duplexes to fourplexes. Anything more than 4 units is considered commercial. Some multifamily homes have a separate entrance for each unit, while others may share a main entrance. The distinction between a multifamily unit and a condo is that the units can be purchased individually, where one owner holds the whole building. The pros, the multifamily homes are ideal for those looking for an investment property. You can decide to live in one unit and rent out the others for income, or rent out all the units. There's also a great option for multi-generational households, as they allow family members to live in the same building but to have their own unit. The units tend to be smaller, though, than the single-family homes and less private. And as a landlord, you're bearing all the costs of maintenance plus the time and commitment of finding renters. A condominium, or condo for short, is a single unit within a larger building or community. Condos can share a wall or two with other units and generally come with homeowners associations, which require the resident to pay monthly or yearly dues. The pro is there is a minimal responsibility of the homeowner's part to contribute to maintenance and upkeep. For example, if the roof goes, you share the cost with other residents instead of paying the whole thing yourself. Additionally, some condos offer gyms, lounge areas, pools, and other amenities that might not be affordable or have space in a single-family home. But condo associations often limit the types of remodeling you could do. There can be a pet or rental restriction as well. Homeowners associations want uniformity and safety. You don't want one homeowner replacing doors and windows if they're not to be of a high standard or safely installed. In addition, because you share a space with others, there's not so much privacy, so you need to be extra cautious of disturbing your neighbors because they are so close. A townhouse is a hybrid between a condo and a single-family home. There are often multiple floors with 1 or 2 shared walls, and some have small yard space or rooftop decks. They generally are larger than a condo but smaller than a single-family home. Townhomes often have more privacy than a condo. Some have homeowners associations or joint maintenance agreements to share the costs. Townhouses don't usually have shared amenities like a gym or a pool, and they're not as private as a single-family home.
Rosemary, I love that you're breaking down the different categories and the different distinctions, because I think this is really important for people to know. They might not want to deal with maintenance of having a home and having a property, but they might want things like animals. And there might be more restrictions on having things like pets or a dog or a cat and having fees you have to pay monthly on top of that. So I love that you're breaking this down, because I think it's really important for people to understand the different types of pros and cons of each type of house.
Well, it's going to be based on your lifestyle. If you're one that's not going to have time to really maintain your home, like landscaping, you may want to look into a condo or a townhouse and look to see what the homeowners association fees are compared to what it would cost you to hire, say, a landscaper for a single-family home. What are the restrictions on the townhouse and the condominiums, or we'll actually talk about cooperatives in a second, as far as pets, or if you wanted to paint your door a specific color, did you have to get approval from an association? So it depends on your lifestyle. If you're someone that likes to be creative, maybe having an association that's going to limit your creativity is not the way to go, as opposed to someone who just wants something where they're going to just be there to sleep, so then they don't want all the extra amenities. So that's basically is going to determine what you want to do. And of course, the multifamily house, if you do have parents or children that you want close by, but not necessarily under your specific house, your specific roof, they can be in a multi-dwelling unit. So a cooperative is another option, and they're called co-ops for short, and a slightly different way of holding a title to be shared. They're shared with the building. With a condo, you own the space within your unit. But with a cooperative, everyone owns the building together, and they have a shared responsibility. There's also an interview process to make sure that you're welcome to be part of that community. The co-op owners usually take on maintenance, or as a community, they tend to have lower association dues. They tend to be less expensive and comparable than a comparable condo. The cons are you share financial responsibility for the whole building with your neighbors, which means if someone stops paying their mortgage on a co-op, the bank can foreclose on the entire building. So it's a totally different way of owning property. And cooperatives are generally more in the city, urban settings than they are in the rural or suburbia. And then, of course, you have manufactured homes. They're often sold and transported in sections to be assembled on site. For a time, many lenders were hesitant about offering financing, but that is definitely those regulations have laxed up. And then, of course, land. Land tends to require a much larger down payment, and fewer lenders are available for someone seeking to finance a land purchase. Why? Banks like to know that there's going to be someone living on that land and what it will be improved for. It's easier to know what a property is going to be used for when you see a structure. Plus, you may require utility hookups like gas, water, sewers, and electricity for the land before the structure can be built. So in addition, there will also be permits and zoning limitations. So land is a different kind of animal, so you'll definitely have to seek out a specific lender that possibly specializes in land. Okay, there's different types of lenders, and before you purchase a home or one of the other types of units, you definitely want to get pre-qualified so you know exactly what you could afford to buy and what the payment's going to be in the long run. So credit unions are a nonprofit making money cooperative whose members can borrow from a pool of deposit at low interest rates. A retail bank are probably the banks you're most familiar with. Your checking and saving accounts are held at a retail bank. A mortgage bank specializes in originating or servicing mortgage loans. In the U.S., they are state licensed and work directly with consumers. A community bank is a commercial bank that derives funds from and lends to the community where it operates and is not affiliated with a multi-bank holding company. Then you have private entities that are subject to laws and regulations on the number of mortgages allowed that they can make annually, and they vary by state. An example would be the seller of a property or a hard money lender. And then mortgage brokers do not actually make loans, but they're a third party to help you find one of the other lenders to help provide the financing for you. So they're basically a middleman or middlewoman in some cases. Mortgage products and down payment requirements. Well, there's different loan products. I'm sure some of you have heard some of the terms. FHA, which stands for Federal Housing Authority. USDA, which is the U.S. Department of Agricultural Rural Development, VA, which is the Veteran Administration, Freddie Mac, Federal Home Loan Mortgage Corporation, Fannie Mae, Federal National Mortgage Association, Fannie Mae, which is the State of New York Mortgage Agency, and then, of course, there's non-government sponsored entities. So these are the different government entities that affect your buying ability, and most of these are what residential loans are sold to after they're processed through a mortgage lender or a retail bank. And depending on your specific situation, one of these may be the best option for you at the time. So one of the things they look for is your credit score and your credit history to determine if you're worthy of a mortgage. So FICO credit score, which stands for the Fair Isaac Company scoring models, which is 350 to 800 range, and it is the three agencies that you're probably familiar with, Experian, Equifax, and TransUnion, and their particular model is what mortgage banks use to determine what your credit score is, and in the score, it has the credit payment history, the types of credit that you have, your overall current and available credit debt, the monthly payments and average balances on other loans, and of course, public record information, like liens, judgments, collections. It does not take into account income, employment history, and items not reported to any of the credit bureaus. So your cell phone is not going to be on your credit report unless you missed a payment and now it's in collection. So it gives us basically a snapshot of your payment history and what you owe, so we can determine how much that you can actually borrow. Of course, we also look at your personal and business liabilities. What personal loans you have outstanding, do you have an auto lease or an auto loan, tax liens, judgments, do you have other mortgages and related carrying costs like taxes and insurance on that property, do you have a timeshare, are you paying union dues, work-related expenses, and of course, if you're paying child support and alimony. Those are all some of the liabilities that we look to see to determine how much money you have left over to actually make your housing payment. And we ask you to provide proof of income or employment or business history if you're self-employed. We ask for your federal, personal, and business tax returns, W-2s or 1099s if applicable, pay stubs, Social Security award letter if you're receiving Social Security. If you have a business, a certificate of incorporation, if it's incorporated. If you have a professional license, maybe a letter from an accountant, verification of employment, which means we'll reach out to your employer to make sure you're still working there and that the information you've provided is accurate. And of course, if you're responsible for paying child support or alimony, we'll usually require the court order.
So what's interesting about all of these things that Rosemary's talking about right now is this can definitely seem overwhelming, and it can look like a lot of paperwork and a lot of information, but something that Rosemary and I have discussed a lot in preparing for this webinar is really working with the right mortgage specialist will make this process a lot easier. Is that correct?
It seems like a lot, but if you look at these items, I mean, it's basically your business, not even your state tax returns. We just ask for your federal, personal, and business tax returns if those apply, and then W-2s and 1099. So a lot of these items are things that you would give your accountant right before your taxes are due. So you probably have most of it together. And basically, it's on a case-by-case basis. So if you don't have a professional license, that wouldn't apply. If you're not incorporated and have your own business, that wouldn't apply. And they may not necessarily ask for everything on this list, and there might be items on this list based on your specific situation that we might ask just to basically support your level of income and your work history. So it's really to kind of supply supporting documentation to establish that you are someone that's going to be able to maintain their mortgage and have a good credit payment history. Because we don't want the same thing to happen. We don't want to have another relapse of the housing bubble. So this time we're going to make sure that you actually can prove you have the adequate funds to purchase a home and also to continue to maintain it. And of course, they also look to see what your assets and other compensating factors are. If you have a saving or checking account, if you have a money market, a mutual fund, IRA or Roth IRA, if you have a 401k or a 401b plan with your employer, stocks and bonds, if your life insurance has a cash value, other real estate owned, and of course, you can, if you want to, let us know if you have alimony or child support that you're receiving. That would be optional. That is up to you whether you want us to inform us of that information, if you want us to consider that as a compensating factor or as an asset. So part of the problem with the home mortgage and home buying thing is that there's a lot of terminologies and abbreviations that unless you're in the business that it can seem overwhelming. It's almost like its own language. And there are some terms that you are going to see over and over again, and here's some of them. UFMIP, which stands for Upfront Mortgage Insurance Premium. That is basically an FHA funding fee. And then if you go a little further down, funding fee, which is what the VA or the USDA calls their upfront fee. And then MIP is a mortgage insurance premium, which is that monthly FHA fee that's part of that FHA process. So you're going to see these terms. Private mortgage insurance would be PMI, and that if you're using a Fannie Mae or Freddie Mac product and you're putting less than 20% down, that's required, and that protects the lender against default. There's points, and that's a percentage of the mortgage amount paid to originate the mortgage, which may impact rate. You know, they also call it a buy down. So if you're paying a point, that means you should be getting a slightly lower interest rate because you're paying to lower that interest rate. And it's also called a buy down. So it's basically a fee in exchange for a lower interest rate. So when you're comparing to close, look to see what the points are or if there's a buy down fee. Because if the rate is 4% and one is charging you a point or a buy down fee and the other one is not, it may be a slightly higher rate, but maybe it actually is a better deal. So compare apples to apples and make sure you read the fine print because they usually will put the interest rate in big bold print and then the fees in very small print. So the big prints give us and the little prints take us away. So try to make sure that if you're comparing again apples to apples. Of course, there's a commitment fee. Some lenders will charge you a good faith fee just to process your mortgage. Not all lenders do that, so you can avoid that by asking them what their fees are, if there's anything up front. And usually that fee is refundable at closing, but once you've paid that fee, chances are you're not going to switch lenders if you're unhappy because you would lose that good faith deposit. Other lenders will also charge you a lock-in fee because they don't want to lock the rate, which ties up the money that they're intending to lend to you unless you, again, give them a good faith deposit. And unfortunately, again, would you change your lender if you were unhappy once they had that good faith fee that you were potentially going to lose? And then title insurance is an insurance policy that covers the loss of ownership interest in a property due to legal defects, and it's required if the property is under a mortgage. So those are one of the fees that you're going to see on your closing disclosure or your fee sheet once you apply for a mortgage. And again, the terminology seems to be a lot, but if you sit down with a licensed mortgage specialist, they'll go over which items apply to you and which products the products that may have these items involved. So again, if you're doing a Fannie Mae loan or Freddie Mac loan and you're putting 20% down, then there would be no private mortgage insurance. So some of these terms may not apply to you. If you're not doing a VA or USDA loan, then there wouldn't be a funding fee. So the terminology is going to determine on which product in your specific situation. So here's a sample of a monthly housing payment. So the first item would be your principal and interest. The second would be real estate taxes. So if you're buying a property, what are the property taxes each year? If you divide that by 12, that would give you that 542 number. You're going to have homeowners insurance on the property so that if there's a fire or damage to the home, that you have insurance to make sure that the home can be restored because the home is collateral. So you're required, if you have a mortgage, you're going to be required to carry homeowners insurance. And again, if the homeowners insurance is $1,200 a year, you divide that by 12, and that's where they come up with that $100. If it's in a flood zone, then you have to consider flood insurance. If there's an association for a condo or a co-op or a townhouse, you have to also determine what that monthly fee is going to be and consider that as part of your housing payment. And if you put less than 20% down on a conventional loan, you're going to have mortgage insurance, or if it's an FHA loan, or then you may also have mortgage insurance. So that's part of your housing payment. So you have to determine what items apply to you, add them up, and that is your total housing payment, and that's what they're looking to qualify you for. So your income has to be sufficient for you to be able to carry that $1,512 a month in this particular circumstance. And it's also referred to as PITI, which is principal, interest, taxes, and insurance, a combination of all the things that are generally required with your housing payment.
The other thing that's really interesting about this slide as well, and I love that Rosemary put it this way is that the other thing that's really important is you have to remember your principal and interest payment may not change, but depending on where you're living, if your taxes go up a little bit each year, that amount that you're paying and putting in towards taxes will increase your overall payment. So you have to take into account when you're looking for a home what the taxes are in that area and how that will affect your overall monthly payment. Because depending on how some people structure their mortgages, the bank will pay taxes into that for a person. Is that correct?
More and more, the lender would prefer that they pay the property taxes and insurance for you. So they'll take the amount that you owe annually, they'll divide it by 12, and they'll put it into the monthly payment, so that they know a year later when those items are due that they have the money to pay it for you. So if you didn't save, so if your homeowner's insurance is $1,200 a year and you didn't set aside the $100 a month to pay it a year later, then you would be struggling to come up with the $1,200 and your homeowner's insurance might lapse. So the lenders would prefer, most of them now would prefer to actually pay it for you, so that it's almost like a forced savings. But you may have the option of paying it on your own. But a lot of people during the housing bubble paid it on their own, and all of a sudden they got a $6,000 tax bill, and they had not paid the $6,000. And if you have generally 3 years lapsed taxes in certain municipalities, they'll put a lien on the property. And again, the property is the collateral, so the lender is going to be hesitant on letting you necessarily make your own property tax bill or homeowners insurance, because if it lapses, then it's a possibility that it's going to affect the collateral, which is the house itself. So, but that is possibly one of the options, and again, something that you'd want to sit down with your mortgage specialist to see if that's an option that you're comfortable with, or if that's even a possibility for your specific loan product. This is not necessarily an option depending on the loan product. They may want you to, it's called escrowing, where there's actually taking aside the taxes and the insurance so that they'll pay it for you. So that's one of your options possibly. And actually more and more people have a preference of having it part of their monthly housing payment, so they don't have to worry about trying to save it and spending it when it's due, not having the total amount. So what they've tried to do is to make it more transparent. They've changed some of the disclosures. So when you decide you found the home and you go into contract, you're going to fill out an application, and part of the application is going to be the loan estimate. So it's going to be a breakdown of what your loan amount's going to be, the interest rate that's being quoted. If it's locked, it will actually say on the form that it's also locked, but you don't necessarily have to lock it immediately, but they're going to quote you a rate based on your criteria at the time of application. They're going to give you a payment. In this case, $761.78 would be the monthly principal and interest based on that 3.875% interest rate and that $162,000 loan. It's going to let you know whether there's a prepayment penalty and whether there's a balloon payment, which means a whole bunch of money is due at the end as opposed to just paying it down gradually. So most people do a 30-year term. In New York State, there's not that many instances where a prepayment penalty is allowed, so that was going to be more of the exception nowadays instead of the rule. And of course, they're giving you an example of what the payment would be the first 1 to 7 years, and then after that 8 to 30 years, depending again on the loan product. And in this particular case, you have that $761.78, which is the principal and interest. That again, Karen was saying that once you lock it in, it's going to be the same for 30 years. So that's not going to change. The mortgage insurance, if you look at the second line, in this particular case, it's $82, but it's only going to be for the first 7 years. After that, that is eliminated. And then you have your estimated escrows. That would be the taxes and insurance that we discussed earlier. In this particular case, it's only $206. Obviously, we live in New York, so it's probably a little more depending on the county that you live in. So in the first column, total housing payment they have, as an example, is $1,050. That's years 1 through 7, and then after that, years 8 to 30. In the next column, it reduces to the $968 because that mortgage insurance has been removed. And then below that, it basically explains that $206 in the column above it, that $206 a month, which is the estimated taxes and insurance, and you could see that they checked off property taxes and homeowners insurance. If it was only for the taxes, then they would have only checked off the property taxes, and vice versa. In this particular case, and in most instances, it's usually both items. Then you have what the estimated closing cost would be, and then the cash to close. And part of that cash to close might be the down payment or the balance of the down payment, depending on what you put down on contract. So if you go to page 2, they've tried to itemize it for you to make it a little bit more clear. This form is much easier to understand than the ones previously, and I think that was part of the problem with the housing bubble, is that people really weren't sure what they were paying with fees and how, and they could change from when you sign the application to when you got to the closing table. Nowadays, there's very, very strict guidelines, so it's more definitely consumer friendly, and they're looking to try to make disclosures as simple as possible and as easily understandable as possible. So here you have everything itemized. The first section is origination charges. Those are the fees related to the lender, and they could vary from lender to lender. Then the second would be services that you cannot shop for but are not necessarily the lender. So, for example, an appraisal fee. The appraisals nowadays go through a pool, an appraisal management company. So and most lenders use a specific management company. So you can't shop for it, even though it's not a lender fee. It's a fee that lender requires you to use that specific company. So things like a credit report, a flood determination fee to make sure that the property is not in the flood zone, and so on. And then you have column C, services you can shop for. So you'll need to get a pest inspection. For example, if you're doing an FHA loan, which would be a termite inspection, and so that would be something you could shop for, and they're going to give you an estimated cost. So in this particular case, $135, which gives you a decent allowance on how much that would cost. So it might only cost you $100, but we're going to tell you it's going to be approximately $135. So these are things you could shop for. So if you can get it for $90, then it would only be $90. Survey, you may require a survey. But you may be able to use an existing survey that the seller has. So you may not necessarily have to get a survey, but again, that's something that may be associated with the purchase of the property. And then title insurance, which again is an insurance that protects the home ownership against defects in title. And you have different types of, you have a lender's policy, and you'll find there's also an owner's policy on the next column. Title searches, other building violations. So these are the items, again, that you could shop for. And then if you add those A, B, and C, that's where they came up with the $56.72. So this is going to give you a ballpark of what you're going to need approximately for your closing fees. And you go into the other column, E. In New York State, we have mortgage tax. So that would be in this column. And not all states have mortgage tax, but New York State is one of the few states that do. And then if you go into prepaid, well, you're going to have homeowners insurance, and they're going to want a certain amount to be paid prior to closing. So generally, they want you to pay 1 year of homeowners insurance up front. If you're paying the monthly mortgage insurance premium yourself and not adding it to the actual loan amount, you can do that here. And then, of course, it goes into property taxes. And if you go into G, then you have homeowners insurance, property taxes, and that's part of your escrow account. So they're going to collect a couple of months of each at the closing table, because you're not going to get your first mortgage payment immediately. So if you close on May 15th, you may not get your first mortgage payment until July 1st. So they have to account for those 2 months where there's no collected taxes and insurance. So they're going to collect them at the closing. So a year later, you're not going to be short those 2 months. They actually need 12 months to have that annual premium. Title owner's policy. It is optional, but most people do get the title owner's policy because that protects your interest in the deed of the property. And then if you add all those items together, again, most of it is escrows, advances, prepaid. That's the $8,054. So not necessarily fees. They are things that are required to be paid for, like your taxes and insurance. And then they have a breakdown of how they came to that $16,000. In this particular case, they had the down payment was $18,000. They had already put a $10,000 deposit, and if you added those items up, that's where they got the 16,054. And again, once you sat down with your mortgage specialist, depending on your specific loan amount, your interest rate, your specific county, these are going to vary, so they'll be able to go through it with you line by line. And if you're not sure what one of the items are, you should definitely discuss it with them and determine whether it's necessary. Speak to your attorney to determine whether it's necessary. As far as the items that you could shop for, you may want some referrals. And basically, they've tried again to make it more consumer-friendly as far as reading it and understanding it, and what items, again, you could shop for and which ones you cannot. Now, a lot of people ask for how much money I'm going to need and to have saved to buy a home, and there are some options besides your saving your down payment. There are down payment assistance programs out there, depending on where you live. There are community-held seconds in some areas. There's sweat equity, where you're helping to, renovate the home and putting time into it. So that would be something like an organization that we have here, which should be Habitat for Humanity, in which they allow sweat equity to be part of the requirement in buying their particular properties. You can get a gift from a family member. You can get a lender's credit. A lender's credit is when the lender raises the interest rate and gives you a credit back that you could use towards your closing costs. So if you're short money, there is some ways of being a little bit creative and coming up with a difference. So don't necessarily think that you're not going to be able to come up with all the money. Maybe there are ways where you can incorporate it into the loan. And a seller concession is when the seller agrees to raise the price of the property and then give that amount back to you. So if they raise the price of the purchase $5,000 and then they say, we're going to give you the $5,000 back, that $5,000 can be used towards your closing costs. So that's another way of possibly having to come up with less money to bring to the closing table. And of course, there may be grants that you're eligible for. So if you're looking to buy and you want to see what's available, those are the things that you might first consider. So not necessarily think that you don't have the adequate amount of funds. So the next step is to start looking to get an idea of what kind of property you want to purchase, what is out there in your specific area, what the property taxes are on a particular property, if it's a condominium, townhouse, or a cooperative, what are the association fees associated with it. So one of the things you can do is obviously a lot of people will go onto Zillow and Trulia, which are very popular sites. A lot of people don't realize that on Zillow and Trulia, they only post about 60% of the active listings, and not all the information is accurate, because it's really not a real estate site. It's actually a marketing site. They're trying to capture your information and sell it to a realtor or a mortgage person. So they're not too interested about the accuracy. They're just interested on having pictures and pop-ups that are going to get you to click, I want more information. So try this free app on your smartphone. It's called Home Scouting, and find out what you've been missing. You can download it on your smartphone, your tablet, or just go online. And what you need to do is just create an email account with a password, and just use my VIP code to get in, which is my first initial and my last name. And it's a great tool to help you or someone you know find the perfect home. First, it's private. None of your information is sold. With websites like Zillow and Trulia, they sell your information. So if you don't want to get pesky phone calls or emails because you've clicked on, I want more information on a particular property, this is a great app that you can use. So I work for Fairway Independent Mortgage Corp. We are a national lender. We're in 50 states. We are a direct lender. We're the 8th largest retail lender in the country currently. And of course, my information is on the bottom of each slide. So if you have any specific questions or you have a specific scenario that you'd like to discuss, I'd be more than happy to help you. And if it's in a different state outside of New York, I could definitely refer to you to one of our branches. So Karen, do you have any questions?
Sure. So I know I definitely have a couple of questions. I'd like to see if others have questions as well. Please feel free to ask or type any questions that you have in the chat box that you have available to you on join.me. This was our third webinar in our Alumni Financial Summer Webinar Series. So we had sent out a survey a couple of months ago, and our alumni overwhelmingly said they wanted to hear about all these important topics: investments, conquering debt, the American dream, myths and truths about buying a home, which you just heard. And now you'll be hearing September 14th, our retirement planning webinar, which is the last webinar in our summer financial series. So this is an excellent series of workshops for anybody who's interested in all different types of financial information. You can keep our conversation going on our Twitter page at SJCNY Alumni. You'll see we've been tweeting about this webinar all night long, and you can use the hashtag SJCNYDream if you have questions or if you want to connect with us or with Rosemary about this topic. You'll also be able to find us on LinkedIn on our St. Joseph's College New York Alumni and Friends page. You can reach out to myself, Paige Carbone, or Lisa Galasso. Send us a message. Connect with us if you're interested in anything related to professional information for St. Joseph's College alumni. We also have our Facebook and our Instagram pages, so you can find us on Facebook at St. Joseph's College New York Alumni and at Instagram for all things SJCNY Alumni related. And we are gearing up for our Centennial Concert on Friday, September 30th, 2016 at the Space at Westbury. Lisa Galasso has just put the link to purchase tickets in our chat box if anybody's interested in doing that at this point. This is our largest fundraiser of the year. All proceeds from the concert will go to our Centennial Fund, so this is an excellent concert that I don't think anybody will want to miss. But at this point, we'd like to invite your questions for Rosemary. And I have one that I've been wanting to ask all night. So I love the information that you gave about different types of mortgages, different types of products, right? So when you think about points and you think about what does that mean? So when somebody says, well, I have 1.5 points, so we're going to give you a half a point, what are the reasons or what are the things that people could get points?
So a point would be 1% of the loan amount, so $1,000 for every $100,000 that you borrow. So if you wanted to lower your interest rate, so if the going interest rate was, say, 4%, and you wanted to get a lower interest rate, you could pay points, and depending on how many points you pay, you may have a slight decrease in your interest rate. So instead of paying 4%, you may be able to pay 3.875 or 3.75%. So be careful, because if someone's advertising a 3.75, and you don't read the fine print below it that says, well, that you need to pay 1.5 points to get to that rate, and someone else is advertising 3.875 with 0 points, the one with the higher interest rate may actually be the better deal, because you're not buying down that rate, which means you have to come up with more money at the closing table, or you have to get creative with either a seller's concession or a lender's credit to be able to offset it. So just keep in mind those points, and even be wary of lock-in fees or commitment fees, because it's a way to basically make sure that you're tied into that particular lender or product, because you don't want to lose that amount of money. So when you are comparing, whether you're comparing lenders or products or interest rates, do you compare apples to apples? What fees are involved? Are there buy-down points? Am I getting a credit back, which would be a lender's credit? And that would be the opposite of a buy-down, and where you're actually paying a higher interest rate. So instead of paying that 4%, maybe you're willing to pay that 4.25%, but you'll need less money at the closing table because the lender's giving you a credit back. But keep in mind, though, that you're going to be paying that higher interest rate for 30 years. So if you may not want to, get the lender's credit unless you definitely need it. And again, it comes down to the math. So the thing about buying a house is a lot of emotion is involved, because it's a place you're going to live, and if you've grown up in that community, or your children go to the school in that community, or it just reminds you of the home that your grandmother had. So sometimes you make decisions based on an emotional attachment versus what should be a mathematical equation. These are the fees, these are the choices, what makes sense mathematically and is your best interest, because it does come down to being an investment. And it's an investment that can grow with value. I mean, especially now while the market has stabilized and is inching back up, some people come to me, first-time home buyers, and they'll say, well, we're interested in buying, but we want to save an extra $10,000. And I'll ask them, well, how long will it take you to save an extra $10,000 for a down payment? And they may say 6 months to a year. And I'll say, do you think that the houses that you're looking at now may actually cost you $10,000 more 6 months from now? And that is a possibility, because it is supply and demand. And right now there seems to be, in certain areas, a pent-up demand because people have delayed buying property because of the repercussions of the mortgage collapse. So if you think that the values are going to go up, then you have to reevaluate, does it make sense to wait? Because if you bought the house now and did not wait to save the $10,000 and the house did go up in value, and you had $10,000 in equity 6 months later, you actually made $10,000 just by buying it sooner than later, and instead of paying rent, you were actually paying down some of your principal. And of course, one of the options we talked about earlier in the presentation is it might be also a possible tax benefit on your income taxes, and that's things that you should discuss with your accountant. So, if you're thinking about buying, you don't need a lot of down payment. What you do have to be aware is of, are you going to be comfortable with the mortgage, the housing payment, which encompasses the taxes and the insurance, and mortgage insurance is depending on what mortgage products you're using, association fees, again, depending on what type of property. If you're comfortable making that monthly payment, as opposed to the rent that you're paying now, and you have to consider whether the pros and cons. The pros and cons are, well, you may be building equity if the market continues to increase. You have to live somewhere anyway. So the reality is you are paying the mortgage payment. The question is, are you paying yours or your landlord's? In 30 years, if you do a 30-year term, or again, you don't have to do 30, you could do 15 to 20, but most people do 30 because it keeps the monthly cost down. Of course, you could always prepay it, so if you wanted to pay it down faster, you could send additional principal in. But not necessarily a wise thing to do. You should really consider paying other high-cost loans first. So pay down your credit cards or other personal loans, because usually the interest rate is much higher. And with the mortgage, you may be getting that tax benefit. So if you don't have a mortgage payment and you're getting a $3,000 refund every year, and all of a sudden you've paid off your mortgage, you may actually be losing money in some way. So again, you should discuss it with your financial planner or your accountant to determine if it makes sense. Some people will take out a full mortgage on their property just so they have a tax write-off, because it was a benefit to them and their overall scope of things. And it's nice to have control. I mean, the thing about rent is most of the time rents go up. How often does your landlord knock on your door and say, "You've been such a great tenant, I'm going to lower your monthly rent"? Usually they'll leave it the same if you're a good tenant, or they'll gradually increase it, or sometimes they'll increase it by a significant amount, and all of a sudden you have to try to find a place that's going to be comparable with supply and demand, depending on where you live. You may be forced to be paying that higher rent. I've had people, not just people in their 20s, 30s, 40s, and 50s that are first-time home buyers. I've had people come that were in their 60s that had never purchased, had always rented, and they had rented in the same development for years and years and years, and eventually the homeowner said, "I'm selling." And now all of a sudden, after being somewhere for 20 years and being comfortable with their rental payment, that they had to find someplace else. And they realized that 20 years had passed them by, and they could have paid down 20 years worth of mortgage payments. And here they were at 60 starting to make a 30-year payment. So they delayed in buying, but eventually they realized that it was definitely more suited for them. Now, I'm not saying everyone should buy. You really have to, again, determine your financial stability. You have a steady income. Are you going to be able to maintain your mortgage payment? You don't want to put a down payment, live in the home, maybe make some improvements, and then wind up losing everything you put into it. So you have to look at the overall picture, try again to take the emotion out of it. A lot of times people are not sure where they want to buy, so they don't really have a starting point. My recommendation is drive around to the area that you think you want to live in, and visit the local parks, go there at different times of the day. You have to really determine what area is best suited for you. I mean, your distance to work, is it near public transportation? That's really the homework you should do first. It's like, what area would be ideal, and then look at the property values, look at, what the property taxes are, and to see that you can actually afford that particular property. And then if you can't, then you could expand your search and maybe find a neighboring community that would be close to where you want to be, and maybe on the outskirts of town as opposed to where your ideal place would be. But first determine what is your lifestyle. What is the proper type of property that's going to suit if you're never home, do you want a sprawling house with an acre of land? If you're not going to appreciate that land, then it's just going to be more of a burden versus living in a cooperative where you have very low maintenance and maybe you have amenities like a pool or things that you're going to use. So you need to look at your lifestyle. And remember, things are not permanent. You could buy a starter home, or you could start off in a condo and then sell it in a few years. You'll take that equity and buy something bigger, or different types of properties depending on the changes in your life. You might get married, you might downsize, you might retire, that kind of thing. What if you're looking at a condo and cooperative, do they allow pets? What are the restrictions? How close are your neighbors? Are you a sound sleeper or are you a light sleeper? Do you want to have neighbors? So these are all questions you have to ask yourself. It's not a decision that should be made lightly, but I don't want people to be so afraid that what's going to happen in the past will happen again. Obviously, we have the internet. There's a lot more information available, although be careful that sometimes there's too much information. You really need to sit down with someone in that field that can make sense of all that information, because it can be overwhelming. But you should definitely think about it, and if it's not now, it might be down the road. But again, you're paying someone's mortgage. The question becomes, is it yours or is your landlord's? And also, you don't have to buy a house yourself. If you have a family member, if you're both paying, $1,500 a month rent for a tiny little studio somewhere, if you combine your incomes and your assets, you may be able to buy a 3-bedroom house and that has a big backyard and actually have maybe a better lifestyle and some companionship and someone to offset the expenses. So you could do that with family members, you could do that with friends, and also even with down payment. If you're a veteran, one of the advantages of being a veteran, if you do a VA loan, is you don't need any down payment. You still have to qualify for the loan to be able to pay the housing payment. Your income has to qualify, but you don't need a down payment, and some of the closing costs can be put into the loan. And there's other products as well that you just need maybe 3% of a down payment or 5%. Depending. It really depends on the property type and the loan amount, and again, your income that you have to support that and your other debt. We want to make sure that we're handing you the keys to the house, that after you move in, you're going to be comfortable making the housing payment, and you're still going to have adequate amount of income and funds to make your other payments, whether they be a car loan, a student loan, a credit card bill. So those are things to consider, and that's why it's best to start analyzing your budget and determining what you're comfortable with even before you start looking. And then use the app to see what's out there. The Home Scouting app is a great app. It's confidential, and it gives you the property. It's up to date. It's as accurate as multiple listing service, so it gets updated daily. And the property taxes are on there. There's pictures of the property. There's even Google Earth if you want to get a good glimpse. And then it has the addresses of the property, so you can literally drive by, see if you like it from the outside, drive around the neighborhood, see if the neighborhood's suited for you, and then you have a starting point. And of course, everyone's welcome to call me or email me if they ever have any questions, or if they just want to sit down and kind of do an analysis of what they have to work with and see if there's a plan that they can get on.
Thank you, Rosemary, for your time. We want to thank you so much on behalf of St. Joseph's College for sharing this information with our community. As Rosemary has said many times, her contact information is on the slide, so please feel free to reach out to her directly if you have specific questions or if you'd like to talk to her about something specific to you. We will be sending out a survey to all of our participants for your feedback, which is extremely important to us, and we'd like to thank you on behalf of the college for joining us this evening.